Hi there, Etoro. It is Monday the 3rd of July, and that means it's time to take a look at what moved the markets last week. The end of last week brought the end of the first half of the year, which is very interesting because the NASDAQ composite, not the NASDAQ 100, the NASDAQ composite, which instead is made up of 2,500 companies, finished the year with its best result since 1983. The rally through the first half of the year has been one of the most hated rallies of all time because it's left a lot of people scratching their head wondering how could the market possibly rally so strongly when there are so many negatives when it comes to the current economic conditions. In addition to this, we also saw a record being broken with Apple finishing the day as the world's first $3 trillion company. Apple continues to power ahead in terms of its share price. I know that it's a company that has a fantastic future, but earnings growth hasn't been good, revenue growth hasn't been very good, and the outlook, the short-term and medium-term forecasts for the company aren't fantastic either. So this is a bit of a head-scratcher. In terms of macro goings-on last week, there was a lot that hit the market, but probably the most watched numbers were the GDP out of the US, which surprised to the upside and by quite a large margin, as well as the core PCE numbers, which is the inflation number that the Fed prefers to use when measuring inflation, which surprised slightly to the downside from a year-on-year perspective. If we look at the trend for core PCE, we can see that it is down, but it has been particularly sticky. And this tends to ignite concerns that it could be very easy for this trend, slight trend downwards, to reverse and for core PCE to stay where it is or even start ticking upwards once again once the base effects are out of the way. What we can see from growth in US GDP quarter on quarter is that it is still incredibly strong at 2%. However, the trend is downwards. And as we all know by now, the effect of the interest rate hikes is not something that become apparent immediately. It does take months or even a couple of years for those interest rate hikes to feed their way through the various mechanisms within an economy. All right, with macro out of the way, I did want to touch very quickly on 3 companies in my portfolio that have done very well over the past week, and I would like to do a deep dive on one of these companies, which will probably come out on YouTube on Wednesday. The first of these companies is Overstock, which is a very strange company. On the surface of it, it seems like it is just another online retailer, a company that sells furnishings for the home. But in addition to this, it has its finger in many pies. It's a company with a very interesting history, including being one of the first companies to accept Bitcoin, and in fact started building out a cryptocurrency component to the company, which is still a part of the business today, although this component isn't apparent to investors that haven't really dug into the business. The reason that this company has popped through the past week, and it's jumped very nicely, is that they have now won the bidding war to buy the intellectual property and digital assets from Bed Bath & Beyond. Bed Bath & Beyond being the company that was in a lot of trouble and eventually had to file for bankruptcy. Now you might be wondering why one company would want to buy another company's assets, especially when that company has done so badly that it went bankrupt. But there can be a hell of a lot of value in the assets of these bankrupt companies because it expands your reach in terms of the customer base that you immediately have access to. But also building a brand can take many, many years, and almost everyone knows the Bed Bath & Beyond brand within the US, at least. Another reason that I think this was a fantastic move for Overstock is because it cost them $21.5 million, which is nothing compared to the amount of value that they should be able to squeeze out of the assets. And Overstock, whilst it has been a company that's had a challenging past year or so because e-commerce companies and retailers right now are having a lot of difficulty, unless you're one of the major tech companies. And this is just a natural part of the economic cycle, the part of the economic cycle that we're in. But Overstock is a business that has been run very well and so has had a lot of cash on hand through the past few years of its operation. Them dropping 21.5 mil to buy these assets and squeeze all the juice that they can out of them is, I think, somewhere around 6% of the cash that they have on hand right now. So I think it will be a very good investment for the business. The second company in my portfolio that's done very well through the past week is a company that goes by the stock ticker of Kufin. It is a Chinese business. It is a fintech company. They facilitate loans within the Chinese market. The business has done very well through the past few years of its operation. However, when China went into those major lockdowns and started really killing the creation of credit within the economy, Kufin had a bit of a rough time. But now that the Chinese government is putting their foot to the pedal, credit creation is starting to take off. It will take some time, but it is starting to take off. you can see that the revenue growth within this business has been incredible. Their profit margins are enormous because they are a technology company. They do not provide the loans. They are not taking on the risks of the loans. They are a middleman that facilitates loans between someone that has the money to lend it out and someone that needs to borrow that money. I know that through the past few weeks, Chinese data when it comes to macroeconomics hasn't been fantastic. It's been a bit of a mixed bag, but we need to remember that this is a country coming out of an enormous financial crisis. It's going to take them some time to turn things around, and Kufin is a high quality company within that economy with incredibly high margins, and when people want to start spending again, they're going to be one of the companies that are going to be involved in those transactions. The final company that I wanted to talk about today that's been doing very well through the past week is Digital Turbine. There is no company out there like Digital Turbine. They've fought tooth and nail to get where they are today. They're a company that provides end-to-end advertising on mobile devices. There's no one else that has the end-to-end offering that they have, predominantly on Android devices where they have a bit more control than with iOS devices, Apple products. One of the key areas in which they operate is they provide software that's baked into the operating system, into Android, and it is shipped on phones that their OEM and operators provide, so all the names that you see on screen right now. And this means that app developers or other types of companies are then able to take advantage of the software that is pre-shipped on those devices, the software that Digital Turbine owns. No one else has a cradle to grave, to use an analogy, solution for the mobile advertising market. But the biggest challenge that has faced Digital Turbine is that in periods when economic growth is weak and people are worried about money, they spend less on more expensive purchases. One of those more expensive purchases being mobile phones. There is a direct and very strong correlation between the number of Android phones being sold and Digital Turbine's revenue and therefore profitability. And so if we could take a quick look at their revenue, we can see that when all of that helicopter money started hitting the market, people really started spending on electronics such as mobile phones, and revenue for Digital Turbine and others went through the roof. However, this also meant that there was a lot of demand pulled forward for them, and now because we're in the opposite situation with high interest rates and high inflation, people have been spending less money on these larger purchases. There is a name for this type of business. This company is cyclical. They are synchronized with the cycle of the economy. And if you are the best performing company within your class, when the economy does take off again, guess what? Your company is likely to experience explosive growth. All right, moving on to this week. Like I said, tomorrow is a very large holiday within the US, and today is a half day for the US markets. But we will see a lot of important macro data beyond that through this week. The theme for this week is most certainly the labor market, employment, jobless claims, etc. So you can see that jobless claims will land on Thursday, as will JOLTS on Friday, NFPs, as well as the unemployment rate. I say this time and time again, but the reason that these things are important is because investors know that the Fed is watching the strength of the labor market to determine what it does with its interest rate hikes through the rest of the year. And that segues quite nicely into what the market will be watching most closely through this month. And there is an expectation that the Fed will raise interest rates within the US by another 25 basis points through this month. That's more or less baked in right now. However, what investors will be more interested in is if the Fed drops any hints about what they're going to do next through the rest of this year. All right, that's it for this week. I'll speak to you soon. Have a good one. Goodbye.